In 1995, a company few had heard of doubled its stock on its first day, and the world decided that profits no longer mattered. In just 4 years, internet users soared from 2.6 million to 45 million, and initial public offerings exploded, turning everyday Americans into overnight entrepreneurs. This is the story behind the internet gold rush that reshaped fortunes and expectations, and left behind a question: how could that much wealth vanish almost overnight? On August 9, 1995, Netscape Communications made its debut on the NASDAQ. The offering was supposed to be modest. Shares were initially set at $14 each, but in the final hours before trading began, the price doubled to $28, driven by a surge of demand that caught even Wall Street off guard. Frank Quattrone at Morgan Stanley, the lead banker on the deal, pushed for the increase after seeing institutional investors scramble for a piece of the action. The market's appetite was so intense that trading was delayed for nearly 2 hours due to an overwhelming order imbalance. When the opening bell finally rang, Netscape's stock launched at $71 a share, more than 2.5 times its initial offering price. Within minutes, it soared to an intraday high of nearly $75 before closing at $58.25. By the end of its first day, Netscape, a company with just $17 million in revenue and no profits, was valued at over $2 billion. Within months, its market cap would approach $9 billion. The company's founders, Marc Andreessen and Jim Clark, saw their stakes balloon overnight, with Clark's share alone worth more than $500 million. Netscape Navigator already dominated the web browser market, controlling about 70% of it, but the real story was the speed and scale of internet adoption. In 1990, there were only 2.6 million people online. By the time of Netscape's IPO, that number had exploded to 45 million, doubling every year. The public response was electric. Media outlets called it the Netscape moment, the instant when the internet stopped being a science project and became a business opportunity. For investors and entrepreneurs, the message was clear. Growth mattered more than profits. If a company could capture users quickly, Wall Street was willing to overlook red ink on the balance sheet. The Netscape IPO did not just raise money for one company, it rewrote the rules of valuation. It showed that a fast-growing internet business could command a multi-billion-dollar price tag before ever turning a profit. That logic would soon spread across Silicon Valley, setting off a chain reaction that would define the next 5 years of the American economy. By 1998, the internet boom had turned into a national obsession. Across the country, new startups were launched at an unprecedented pace. Gallup polls from the time suggested that 1 in every 12 Americans believed they were starting a business. The race to go public reached a fever pitch. In 1999 alone, 457 companies made their debut on U.S. stock exchanges. Of those, 117 saw their share prices double on the very first day of trading. The scale was staggering. Investment bankers were cold-calling companies before they had even finished unpacking in their new offices, eager to broker the next big IPO. Nothing captured the mania like the globe .com. On November 13, 1998, 2 college friends, Stefan Paternotte and Todd Krizelman, watched as their social networking site made Wall Street history. The globe.com stock, priced at $9, closed at $63.50, a 606% gain, the largest first-day pop ever recorded at the time. At one point during the day, shares hit $97, more than 10 times the IPO price. Overnight, the founders became paper millionaires. Their faces splashed across financial news outlets as symbols of a new era of instant wealth. The numbers behind the frenzy told their own story. Morgan Stanley tracked 199 internet stocks in 1999. Together, these companies boasted a combined market capitalization of $450 billion, but their annual sales added up to just $21 billion, while collective losses topped $6.2 billion. In boardrooms and coffee shops, the old rules no longer seemed to matter. Venture capital firms poured money into startups with little more than a website and a business plan. Some companies went public just weeks after receiving their first round of funding, using the cash to pay for glossy IPO prospectuses rather than to build out their products. For many, the stock market became a lottery ticket. Retail investors crowded online chat rooms, swapping tips on the next hot .com. The culture of entrepreneurship swept through college campuses and suburban neighborhoods alike. The message was clear: anyone could strike it rich in the internet gold rush if they moved fast enough. The result was a market where hype often counted for more than revenue, and the promise of future growth eclipsed any concern for sustainable business models. Priceline.com promised to change the way people bought airline tickets, but the numbers told a different story. By 1999, the company's market value reached $10 billion, yet its business model was unsustainable, losing $143 million in its first few quarters, and an average of $30 on every ticket sold. The company routinely bought airline seats at higher prices than customers were willing to pay, burning cash for the sake of user growth. Pets.com became a household name, not for its profits, but for its sock puppet mascot and relentless spending. The company shipped $8 bags of dog food with $15 in shipping subsidies, hoping that branding would outweigh basic math. Cosmo.com went even further, offering 1-hour delivery of snacks and Starbucks coffee by bicycle or public transportation, charging nothing for the service. The economics never worked, and the company collapsed in a wave of layoffs. At the 2000 Super Bowl, 17 .com companies spent a combined $44 million on 30-second ads, including a wedding invitation startup that spent twice its annual revenue on a single commercial. Within a year, 5 of those advertisers had disappeared. Money poured into ideas that made headlines, not profits, leaving investors and founders chasing growth at any cost. The result was absurd business models that burned cash and left the market to harden around companies with real economics. Analysts became celebrities, their opinions moving billions of dollars overnight. In December 1998, Henry Blodgett at Merrill Lynch predicted Amazon stock would hit $400. That single call sent Amazon shares up $46 in one day, closing at $289. But while the public saw optimism, Blodgett's private emails, later uncovered by regulators, showed deep skepticism. The SEC would eventually fine him $4 million and bar him from the securities industry for life. Mary Meeker at Morgan Stanley became the go-to voice for internet stocks. Companies like Priceline chose underwriters based on her reputation for bullish research, and she maintained buy recommendations even as share prices collapsed by more than 90%. The incentives were clear. Research departments were tied to investment banking, with bonuses and promotions linked directly to the deals they helped win. While analysts fueled the hype, basic business math was ignored. .com startups were spending $60 to $80 to acquire each customer, but the average customer brought in just $10 over their lifetime. In February 2000, Lehman Brothers analyst Ravi Surya published a report warning that Amazon's credit position was deteriorating. Amazon's stock dropped 20% in a day. Jeff Bezos called the report pure, unadulterated hogwash, but Amazon would lose 90% of its value over the next year. Insiders saw the writing on the wall. In the month before the Nasdaq peaked, they sold 23 times as many shares as they bought, cashing out $45 billion between late 1999 and mid-2000. The warning signs were everywhere, but few wanted to listen. On March 10, 2000, the Nasdaq Composite reached its all-time high of 5,048. Within weeks, the market began to unravel. The Federal Reserve had raised interest rates 5 times between mid-1999 and early 2000, aiming to cool speculation. The effect was swift and brutal. By April, the Nasdaq had lost more than a third of its value. Panic spread across trading floors as hundreds of .com stocks plunged 80% or more from their peaks. Companies that once boasted billion-dollar valuations found themselves teetering on the edge of bankruptcy. Investors watched as trillions of dollars in paper wealth disappeared almost overnight. For the first time in 26 years, September 2001 passed without a single initial public offering brought to market. The collapse was faster than the rise. There was no gradual correction, but a free fall. Once the frenzy ended, the silence was unmistakable. The era of easy money and limitless optimism had given way to a reckoning that spared almost no one. Silicon Valley's scars built the backbone of the modern world. Today, tech giants shape economies and daily life, but euphoria still tempts markets to forget hard lessons. Each click and investment stands on the ruins, and the resilience of a bubble that rewired what risk, reward, and reality truly mean.